The market's sending some seriously mixed signals. While analysts like Tom Lee are calling for a wild $16,000 Ethereum, Cowen warns this is just a fake-out rally before a painful drop. Big money is definitely making moves. Institutions now dominate Coinbase volume, and a White House report hints at a friendlier U.S. stance. But is this good for you? CryptoWendy points out that corporations are snapping up so much Bitcoin, it's becoming the new unattainable American dream. Meanwhile, Joseph Lubin is pushing for Ethereum to be the next big corporate treasury asset. With so much institutional cash flooding in and analysts split on what's next, are you positioned for a massive rally or getting set up for a brutal reset? In the latest video from Altcoin Daily, the channel makes a strong case that we're on the brink of an altcoin market explosion with a special focus on Ethereum. The video points to Fidelity's plan to offer Ethereum trading to institutions as an immediate factor that could push ETH to $2,000 very soon. Looking at the bigger picture, the speaker believes upcoming Federal Reserve rate cuts and the potential passing of the Clarity Act will fuel a massive rally for crypto. This video's argument that Wall Street's arrival will be a huge event for Ethereum feels more relevant now than ever. The core idea that institutions want more than just a store of value seems to be playing out. The recent approval of spot Ethereum ETFs in the United States is a massive step in that direction, officially giving Wall Street a regulated and familiar way to invest directly in ETH. This move validates the video's entire premise. The digital oil comparison is also quite fitting. With the network's fee-burning mechanism, high usage can actually decrease the total supply of ETH, creating a powerful economic argument that appeals to serious investors. While a $60,000 prize sounds incredibly ambitious, the foundational pieces the video talks about, real-world utility and formal institutional on-ramps, are actively falling into place. In the latest video from CryptoWendy, he talks about the recent major dump in Bitcoin's price. He points to the Producer Price Index, PPI, data coming in hotter than expected as the trigger, but he's not panicking. In fact, he sees this as a major trap and a great reset for the market. He explains that this dip is shaking out over-leveraged long positions and resetting funding rates back to neutral, which he views as a healthy sign. His take on the dip as a manufactured shakeout is a classic bull market mentality. When the overall trend is up, many experienced traders view bad news and subsequent price drops not as a reason to sell, but as a discount. The PPI data spooked the market, but his point about rate cut expectations remaining unchanged is a solid counterargument. It suggests the fear was a knee-jerk reaction rather than a fundamental shift. His strategy to rotate profits from Ethereum into other large caps like Aptos and Arbitrum is also a textbook play. It's a move to catch the next wave of momentum after the market leaders have had a strong run. Using 10x leverage on a $150,000 position is an extremely high-risk move, but it shows just how confident he is that this is a temporary dip and not the start of a new downtrend. In the latest video from the Crypto Tips channel, the host discusses Bitcoin and ETH hitting new all-time highs, framing it not just as a win for investors, but as a necessary defense against a failing economic system. He points out that while crypto is soaring, the US dollar is down 10% this year. The video shows how the M2 money supply has swelled to $22 trillion, and the national debt has passed $37 trillion, arguing these numbers will never stop growing. The host is very critical of politicians, using Representative Nancy Mace as an example of someone who publicly worries about the national debt while voting for bills that increase it by trillions. He also offers a warning, noting that MicroStrategy stock is currently much lower than it was during a previous Bitcoin peak, suggesting that the next bear market will be brutal for those who aren't prepared. The video ends by linking these huge economic numbers to real-world problems, citing a Morning Consult report that says 15.6% of Americans don't have enough food, and argues this is why people need inflation hedges like Bitcoin. The video taps into a potent and growing sense of economic frustration. The host's cynical view of politics and the financial system is a sentiment shared by many, especially when looking at the hard numbers like the national debt and money supply. While the video presents Bitcoin as the ultimate escape route, its own example of MicroStrategy's price action shows that the crypto world isn't immune to its own brutal market cycles. The core argument, that a continuously expanding money supply devalues the savings of everyday people, is a valid economic concern. The video effectively channels this anxiety, positioning digital assets as a form of protest and self-preservation against what it portrays as a broken system. It's a compelling narrative for anyone feeling left behind by traditional finance. In the latest video from Lark Davis, he looks at the very bold prediction from Fundstrat's Tom Lee that Ethereum could hit $16,000. This idea, which Lee shared on CNBC, comes from research by Sean Farrell, who suggests the Ethereum to Bitcoin ratio could return to its 2021 high. If that happened, ETH's price would land right around that $16,000 mark. Lee's confidence comes down to three main points. First, he thinks the Genius Act for stablecoins will be a ChatGPT moment for crypto, pushing trillions into the market, and Ethereum is perfectly positioned to capture that business. Second, he says an SEC initiative called Project Crypto is pushing Wall Street to move the entire financial system onto the blockchain, with Ethereum being the top choice due to its perfect uptime and secure reputation. Third, big finance players like JP Morgan and Robinhood are already building on Ethereum. Lark agrees with the fundamental strengths, but questions the timeline. He thinks hitting $16,000 in a traditional 4-year cycle is unlikely, as it would need to happen in just a few months. However, he believes it's very possible if we're in an extended cycle that runs through 2026 to 2027. For this to happen, Wall Street would need to seriously commit to tokenizing stocks and bonds on Ethereum, and the ETH ETFs would need to see continued massive inflows. He ends by saying to keep an eye on major developments, like BlackRock's new Texas stock exchange, because if it chooses to run on Ethereum, that could be the catalyst that makes the $16,000 price a reality. The idea of a $16,000 ETH seems pretty out there, but Tom Lee's points about institutional adoption feel more real by the day. The approval of the spot ETH ETFs was a massive regulatory and political victory that many didn't see coming. It fundamentally changed the narrative and opened the floodgates for traditional finance to treat Ethereum as a legitimate asset, not just a speculative tech platform. The real story, though, is the tokenization of real-world assets. We're past the what-if stage. Major players like BlackRock and Franklin Templeton are actively launching tokenized funds on Ethereum. This is about making traditional markets for things like stocks and bonds more efficient. When you consider the U.S. stock and bond markets are worth over $100 trillion combined, the idea of Ethereum capturing a tiny slice of that makes a $2 trillion market cap and a $16,000 price seem less like a fantasy. Lark's point about an extended cycle seems to be the most realistic take. The plumbing for this institutional shift is being laid right now, but it's going to take a couple of years for that tidal wave of capital to really hit the chain. In the latest video from the Cowen channel, he argues that you should ignore the USD price of your altcoins. What really counts is how they stack up against Bitcoin and Ethereum. He points out that altcoins are in the middle of a rally against Bitcoin right now, a move he predicted and expects to last for another 1 to 2 weeks, likely through the end of August. This surge isn't happening on its own. Ethereum is the one pulling the market higher. Cowen's analysis is interesting because it leans heavily on historical patterns, specifically the September affect on Bitcoin dominance. My take is that this theory is getting a lot of attention right now. The idea of an Ethereum-led fake-out rally makes a lot of sense, especially with the huge amount of excitement surrounding the launch of spot Ether ETFs. That event could easily provide the burst of momentum he's talking about, drawing everyone in right before a potential reversal. His forecast for a final, painful drop for altcoins before a true, sustained rally aligns with what many long-term cycle analysts believe must happen to flush out the last bits of market weakness. It's a contrarian view to the current short-term excitement, suggesting that patience might be more rewarding than chasing this current pump. In the latest video from Coin Bureau, Guy breaks down a 160-page White House report that lays out a new federal plan for the crypto industry. The report signals a big shift towards a pro-innovation and pro-crypto stance, moving away from the old choke point tactics that made banking difficult for crypto companies. The video presents this report as a major positive blueprint for the future of crypto in the U.S. What's interesting is how this aligns with real-world legislative action we're seeing right now. For example, the Financial Innovation and Technology for the 21st Century Act, the FITT-21, which establishes a clear regulatory framework and gives the CFTC more authority over digital commodities, recently passed in the House of Representatives. It shows that the ideas in the report, like ending the SEC-CFTC turf war, aren't just wishful thinking. They have genuine political momentum. The path forward still depends heavily on the Senate and the White House, but the conversation has clearly shifted from if we should regulate crypto to how. The industry seems to be moving toward the kind of structured environment the report describes. In the latest video from the Cryptos Rush channel, the host points out that Bitcoin just set a new record, briefly touching $72,440. A huge part of this push comes from big money players. One unknown whale just bought $656 million worth of Bitcoin, and institutions now account for 75% of the trading volume on Coinbase. This flood of institutional cash is lifting the whole market. The host says this is great for prices now, but it also means these large entities are scooping up a lot of crypto. It's not just about Bitcoin, though. Altcoins are starting to get hot as Bitcoin's dominance falls below 60%. Solana is on a tear, trading above $200 thanks to a ton of activity on its network. Ethereum is also just about $80 away from its own all-time high. Looking ahead, the host thinks the momentum could continue, possibly pushing Bitcoin to $75,000 or even $76,000. He also thinks Ethereum could see $5,000 soon. The video's excitement is definitely in line with the current market feeling. The point about institutional money being the main driver is spot on. We're seeing this daily with the massive, consistent inflows into the new spot Bitcoin ETFs, especially BlackRock's IBIT. This isn't just retail enthusiasm, it's a structural shift in who is buying Bitcoin. While the video focuses on the price, it's interesting to consider how this changes the market's behavior. These institutions might trade differently, possibly leading to sharper, more volatile moves than we've seen in past cycles. The positive sentiment for Ethereum also makes sense, especially with the recent Dinkin upgrade going live. This should lower transaction fees on Layer 2 networks, which could make the entire Ethereum ecosystem more attractive and competitive against rivals like Solana. The market certainly feels like it has strong legs right now, but the reasons for its strength are very different this time around. In the latest video from DataDash, Paul Sampson talks about Ethereum getting very close to its 2021 all-time high of $4,878. He believes we're in the middle of a market rotation where money flows from Bitcoin to Ethereum and then into other altcoins. While he sees Bitcoin continuing its climb toward $130,000 to $140,000 by September, he notes a possible short-term pullback to the $116,000 to $117,000 area for statistical reasons, which he doesn't see as a major concern. The main focus is on Ethereum, which he expects to break its previous high and push toward a target zone of $7,300 to $8,600 in the coming months. This bullish stance is supported by a falling Bitcoin dominance chart and a strong ETH versus Bitcoin chart, which shows a multi-year bullish pattern that suggests ETH will outperform Bitcoin. He also looks at Solana, which he says has a bullish setup pointing to targets of $274 and eventually $323 after breaking through the $196 resistance level. Throughout the video, he mentions using the Blofin exchange for his trades and references his Trader Club Discord for real-time updates. The analysis presented really leans into the classic crypto bull market narrative. Bitcoin leads, then Ethereum takes over, and finally, a full-blown altcoin season begins. The host's confidence in this rotation is backed by his technical analysis of the ETH Bitcoin chart, which is a common indicator traders watch. It's interesting how he uses specific harmonic patterns, like the ones on Ethereum and Solana, to pinpoint entry zones and price targets. This is a very technical approach, and seeing it play out with Solana's bounce from $97 to now pushing $200 gives his predictions some weight. The whole idea that altcoins are in good shape because Bitcoin dominance is falling is a sentiment we often see when the market gets optimistic. It seems the general feeling is that if Ethereum truly breaks its old ceiling, it could act as the starting gun for a much wider market rally. In the latest video from CryptoWendy, she asks a pretty direct question. Do you have enough Bitcoin? She points out that the top 100 treasury companies have already snapped up 1 million of the total 21 million Bitcoin that will ever exist. She compares the struggle to own Bitcoin to the near impossibility of buying a house today, thanks to wild inflation and interest rates. The video suggests that owning just one Bitcoin is becoming a new version of the American dream. Even though she mentions a price of $120,000, which she compares to a $700,000 home in Los Angeles, her main point is that large companies and even the U.S. government are creating strategic reserves of Bitcoin. These big players can print money to buy more, an advantage regular people don't have. Citing a Cointelegraph report, she notes that fewer than 850,000 people worldwide own a full Bitcoin, making whole coiners extremely rare. Her message is a warning not to let these financial giants push you out of what she sees as a finite and valuable asset. The video's core message about institutional accumulation of Bitcoin is spot on. We're seeing this play out in real time with the massive success of spot Bitcoin ETFs from giants like BlackRock and Fidelity, which have absorbed billions of dollars worth of Bitcoin since their launch. This confirms the video's premise that big money is seriously moving into the space, effectively reducing the available supply on exchanges. While the $120,000 price point mentioned in the video feels more like a future prediction than current reality, the underlying trend she describes is very real. The idea of Bitcoin as a strategic reserve is no longer a fringe concept. It's a strategy being deployed by publicly traded companies and now, indirectly, by the largest asset managers on behalf of their clients. It does make you think about the shrinking pie and where retail investors fit in over the long term. In the latest video from The Modern Investor, the host talks about a major shift happening behind the scenes in crypto. It seems there's a new, intense wave of corporate buying focused on Ethereum, much like we saw with Bitcoin. Companies like SharpLink Gaming and Bitmine Immersion are creating huge ETH treasuries. A key figure in this is Ethereum's co-creator, Joseph Lubin, who recently became the chairman of SharpLink Gaming, a NASDAQ-listed company that completely changed its focus to build an Ethereum treasury. According to a Bloomberg report, Lubin says this is the moment for Ethereum, with institutions now integrating it as a core part of their financial strategy, not just exploring it. The narrative is changing from ETH being a world computer to ETH becoming a form of money. The host believes that for Ethereum to truly silence its critics, it needs to reach transaction speeds of around 60,000 per second, similar to Visa. The video also touches on MicroStrategy, which is back in the news for increasing its latest fundraising effort from $500 million to a targeted $2 billion to buy more Bitcoin. This is typical for them, as they aim to accumulate 1 million Bitcoin in total. My take is that the push for Ethereum's institutional adoption feels like a very deliberate and strategic play led by one of its own creators, Joseph Lubin. This isn't just the market randomly picking a winner, it's a calculated effort to position Ethereum as the foundational layer for corporate finance, moving beyond the digital gold story that Bitcoin owns. By taking the helm at a public company like SharpLink Gaming, Lubin is creating a direct on-ramp for traditional markets to get ETH exposure. As for MicroStrategy, their strategy of constantly raising debt to buy Bitcoin is becoming a fascinating case study in corporate conviction. It shows they're not just buying an asset. They're trying to corner a piece of a finite network before other giants can. It's a high-stakes race against scarcity.